Hey guys, it's Cody here from the local home team, and I'm sitting down with my good friend here,
Carmelo from BMO Nesbitt Burns.
And we're doing a three-part investor video series. And basically what we're trying to do is break down real estate investing as well as other investing accounts such as retirement accounts, tax-free accounts, and trading platforms, things like that. So what we did in our first video was really break down how people become landlords and how landlords make money. And just to summarize that real quick, there's three ways that landlords make money, and it's through cash flow, principal pay down, and appreciation. I tend to lean towards real estate investing as a realtor, but also as a real estate investor myself. I tend to err on the side of caution, and personally I do think that it's a safe approach, but I'm really interested to hear what Carmelo has to say about safe ways to trade stocks and trade markets too. So we're gonna let him do a lot of that. But real quickly, again, the reason I like real estate is because there's three ways to make money. It's cash flow, principal pay down, and market appreciation. So I like the combination of three different ways to get paid as the investor. And the other thing is, to me, it comes down to safety. And just maybe I'm not a very complex person, but when I hear about market events that are happening, news going on around the world, I tend to think that, okay, well, not everybody needs Apple stock, but whether or not they're broke, they need a place to live in. So there's always going to be a need for real estate rentals. And that's kind of my theory as to why I stick to real estate, but it's also because what I know. So I'm hoping that myself and you as the viewers can learn a little something, not just from me, but from Carmelo today too. So Carmelo, I kind of made the point that I like real estate because I think it's safe. Somebody always needs a home to live in. We always need a roof over our heads as humans. Is there a safe way to invest in stocks?
There most definitely is. I think we should front this by saying, of course, it is a personal choice and what you want to do. There's no right or wrong answer. I think the goal of these videos as well is just to get someone to start investing. Yeah. Whether it's stocks or real estate or whatever platform, TFSA or RSP, just to start with something.
Yeah, so disclaimer, we're not saying that real estate's better than RSPs or TFSAs or the other way around. We think that the right answer is doing some kind of investing, and you can make that decision on which route you think is best for you in your personal scenario, but hopefully we can help you make that decision up for yourself.
Yeah.
Okay, so there's a few different accounts we can trade in. There's a few ways to trade, whether it's through funds or single stock purchases, things like that. Can you fill us in a little bit on those?
Yeah, so the two most popular accounts to trade in are an RSP account or a TFSA account.
And they're both tax shelters.
They're both tax shelters, 100%. We'll start by talking a little bit about what a tax-free account is.
Sure.
So a TFSA account, as we call it, started in 2009. You were able to contribute about $6,000 a year to it. And so assuming you were 18 years old in 2009, the lifetime limit right now is $65,500.
So even if I wasn't 18 when the accounts were introduced, can I still put in $65,000 at this point?
Correct. No, actually no. It goes with your birthday.
Okay.
So if you were 20 years or 16 years old in 2009, your limit would actually be closer to 55,000
relative to the number of years.
Exactly.
Okay.
So any financial planner or accountant would be able to help you with that number.
Perfect.
But the most common question I get at work or anything, frankly, it's people are under the impression that a TFSA is strictly a savings account. A lot of professionals have actually lobbied to change the name from a TFSA to a tax-free investing account, because it really is not just a savings account. If you can use it as a savings account, and you're going to yield about 1% a year in interest, which really defeats the purpose.
You're not even keeping up with inflation.
Not even keeping up with inflation.
Okay.
So I explain it as you want to look at a TFSA account like an umbrella. Within your umbrella, you can really have anything. Stocks, bonds, GIC, savings accounts, and even real estate. You can have anything within this umbrella, subject to what kind of risk tolerance and timeline you have as well.
So if I was, let's say again, saving up for a real estate investment, or if I was saving up for a new car, TFSA would probably make the most sense, because there's no, I guess the big thing is you've already paid tax on the money that you're putting into the TFSA, so you're not going to be taxed when you pull it out. The money you make inside that TFSA is not subject to capital gains, whereas an RSP, if I put the money in, I dodged income tax on the way in, but if I pull it out, I got to pay tax at that point.
Exactly right. RSP is a tax deferral, so you're not you're avoiding tax for now, but the tax will come. So I like to look at it as time horizon really matters when you ask yourself TFSA versus RSP. If you're in a short or medium time horizon, let's call it even 1 to 10 years, if it's a car or a new house, I would really suggest TFSA over RSP. And then RSP is really that long time horizon, 10, 20, 30, 40 years. It's really going to be RSP. And then the other side of it is income as well. RSPs really get beneficial for individuals that make $50,000 a year or more. If you're making $50,000 a year or less, TFSA may be the better option for you until you maximize it.
Okay. And on that too, RSPs tend to make a lot of sense for people that have income that's all over the place too, right?
Yeah, any sort of commission income or any income that you're just not sure year to year, up and down, you can actually use an RSP as a way to average your income. So if you made really good income in 1 year, you could actually make an RSP contribution, and then say in the following year your income is much lower, you can actually take out that RSP contribution, and then you're going to take it out at the tax rate you're in.
Okay, so kind of to supplement your household budget.
Yeah, exactly. So I'll give you a great example. If you're making $150,000 a year, you're going to be about the 51% tax bracket for your marginal taxes. You can put that in your RSPs, and then you're going to get 51% of that money back from taxes. And then the next year, if your income happens to fall to $50,000, you can take out that same contribution, and you'll have to pay taxes as if $50,000. So it really makes sense from a deferral standpoint.
Okay, so it gives you some flexibility too, right? Okay.
I
So
would
like
say,
you said, it's not just a savings account. You can, there's a lot of ways that it can benefit you.
a lot of ways. Most common is for retirement.
Yeah.
So the most common way is long-term, and then when it is long-term for your retirement, 20 or 30 years, that really gives you growth-oriented options.
Yep.
Because you're not worried about what it's going to be next year or the year after. You're really not worried about volatility. Whether your RSPs drop in value in the next year, it really doesn't matter when your time horizon is the age you're 65.
Okay, so that makes a lot of sense. Another question I guess I had is, I kind of shared the 3 ways I look at making money in real estate as an investor. Is there more than one way to make money on stocks? So for example, we know that homes go up in value, so we make money on the appreciation side of it. Stocks go up in value in theory, or we hope that they do, and we would make money at the time of selling those stocks on the appreciation. Is there other ways to make money on those stocks during the time that you own them, and ways to recognize that without selling them?
Yeah, so there is really 2 big ways of making money during stocks. The way to look at it as well is when you're buying a stock, you're buying a little piece of that company.
Yep.
So you own that company along with many other people, depending on how big your investment is, you own that company. So the most common way people make money is that company value goes up. So if you own 1% of a company, the value's going up, your stock is going up. Now that's similar to when houses gain in value. You're only going to realize that when you sell the stock.
Or if you refi the house, but you could kind of do that with stock
course.
too, right? You pull out your initial investment, let the rest ride.
And then the second big way are dividends. So certain stocks will actually pay you to hold their stock. So whereas you might not get capital appreciation, so a company may not be growing, the company may have tremendous cash flow, and they would be able to pay you cash or stock every quarter. So with that cash or stock, you could take it out as cash, or you could simply reinvest
into the same company
into
again
the
if
same
you wanted
company,
to.
into a different company, whatever you wanted to do. You have a lot of options with dividends.
Okay, so do a lot of people that are in retirement or close to retirement like dividend stocks because they're actually getting money without selling the investment?
100%. Dividends are a great way when you look at anyone who's retired. And frankly, the GIC rates or bond rates right now don't quite cut it. You can't even yield over 1% with a GIC. So we've actually coined the phrase, you're safely losing money, because you're not keeping up with inflation.
Yeah, okay.
So buying a dividend portfolio that has many different stocks, a little bit of bonds, would actually yield you annual cash flow, which you could use on a pretty consistent basis, similar to a GIC.
Okay, that makes sense. So what else do you have to tell us about these two types of accounts, and why does it make sense? Do I have to invest in ETFs? Does it make more sense just to go with mutual funds? Does it make sense to trade single stocks?
You know, it's completely your preference. I would say if you want to trade your own stocks, your knowledge level should be a little bit higher than the entry level, or you should be working with an advisor.
Get a pro to do it for you.
Yes, of some sorts. There are many platforms that allow you to do it on yourself, but you, of course, absorb all the liability, so we expect you to have some idea on how to trade stocks.
Okay.
Between mutual fund and any other type of portfolio, it really, again, depends on what you're looking for. But mutual funds, I would say, are the most common way. Something to look out that has really come up in the last 3 years, it's called CRM2. So it's all a client relationship model, and it's all about pricing of mutual funds. So it really is important to know how much you pay. Okay. Typically mutual funds or segregated funds, which are mutual funds from insurance companies, are typically pretty high when it comes to fees. So you just want to make sure you understand the fee, get what you pay for, and so on and so forth.
So to someone that's new to stock investing, I think the usual disclaimer that goes out there is trading stocks can be really, really risky. Is there a way to do it without a lot of risk? Like, are there low risk? I've heard the term high growth. There's different markets you can trade in. You don't even necessarily have to trade in North America or Canada or the US, right? You can trade in other countries too. Is there a way to get into the stock market without a lot of risk?
I'll preface it by saying, if you're investing in the stock market, it should be with money that, one, you don't need right away, and two, you're okay if you lose it. So I mean, to answer your question, yes, there is growth companies versus sustainable companies. So there are different levels of risk depending on what kind of company you want to invest in.
Okay.
Even the lowest level or the lowest risk companies still have risk associated with it, and nothing is guaranteed. But there are typically companies that are not growth oriented, so have been around for a long time. We can look at financials. They've been around for a long time. The risk of any financial company, the big 5 banks in Canada, going bankrupt, really slim. And because of that, you're not going to get the growth you would get on a new business starting off. They are kind of slow and steady, and those might be considered safer than companies that are small cap and that have just opened up.
Okay, so maybe to bring it into a few quick talking points, I kind of said the reason I like real estate is I think everybody's always going to need a roof over their heads, and the investment pays me in 3 ways: through cash flow, principal pay down, and appreciation. Those are my big 4 talking points, and the reason that I believe in real estate. What are the biggest reasons why somebody would look towards stock market investing as opposed to real estate?
So I do, to counter that, I do have about 4 points as well why an individual would like to look at stocks versus real estate. Those points are longevity, minimal work, access, and liquidity. So if we start with longevity, stock markets have been around for over 100 years, and despite all the crashes, doesn't matter when you buy, it doesn't matter when you sell it, when you're reinvesting the dividends, if you're holding your stocks for a long period of time, it is proven to be the greatest wealth generator in history.
So they got a track record of going
They
up.
got a track record. So if you're going to hold a stock for 50 years, there is no, in fact, we can break it down in 10 years. If you hold a stock in 10 years, there's very little time that in 10 years it has not been higher.
So, as long as the company was well run during that period.
As long as the company is well run, and then we're doing our part and we're diversifying your portfolio. Yep. So you should never be invested in just one company. We'll diversify it as client and advisor find fit. The other, I would say this is probably the biggest reason for me, and to counteract owning a rental property, it's the minimal work. So when you are buying a stock, I mentioned it's like buying a small business, you're buying a business, you're buying a share in that company. You never have to go to work for that company.
And I'll throw into that real quick. So real estate does require active management, right? As a landlord, you are going to get the odd call about, I had it yesterday where an AC stopped working. It's over 100 degrees outside. We got to get somebody over there right away. I'm not fixing the AC myself, but you're still getting the distress phone call. You're still having to hire the company to go out and take a look at it. You might be replacing a refrigerator. The home might need a new roof, things like that. So there is active management. I like the idea of stock because there's no active management.
There's no active management, and once you get your portfolio comfortable and the place you need it to be, you can actually review it once a quarter, once a year, and the stocks are going to continue to grow. So it is that minimal work is really important for me, and that would be one of the biggest reasons to counteract the two. And then I would say closely followed by number two is access. You mentioned before in our other video that in that example, the individual had about $60,000 to put down. Now, for some, that's a huge sum of money, and it takes years and years and years to grow. You can start a stock investment or a mutual fund or anything with $100 a week, $50 a week, $25 a week. So you can get into building your wealth with a lot less money.
So it's a smaller barrier to entry.
Very small barrier to entry, but I see them as working in tandem.
Yep.
If you need to get that $60,000 for that down payment, the way to do that likely would be investing in a mutual fund within your TFSA. You invest, call it, $200 a week, and then you could get to that $60,000 in 5-6 years, which then you could spend on a house.
Okay, so yeah, maybe they work together. Maybe the right answer is we should be doing both.
It's we mentioned it before. It is, at the end of the day, it's personal choice. It depends on what your pocketbook and what your risk tolerance is. But at the end of the day, do something.
Yep.
I think that's the goal to this. The fourth point I wanted to mention was liquidity. Stocks are far more liquid than property.
Absolutely, they are.
Properties, you have to, if you want to get out, you have to sell it. You know better than I do how long it could take to sell a property.
Yep.
Even to refinance a property takes time at the lawyers, at the banks.
And there's costs associated with it too. Yep.
To sell a stock, usually done within 24 hours.
Hit sell.
Press a button and it's done. Could be capital gains associated with that as well, and other costs that you would want to review with your advisor. But stocks, for the most part, are far more liquid than rental properties.
Awesome. So anyways, guys, this is part 2 of our 3-part series. Again, we're kind of looking at investing in general. We're looking at real estate, we're looking at RSP and TFSA accounts, and we hope that this is helpful. Again, our disclaimer is that there's no wrong or right answer when it comes to investing. I've kind of learned today that maybe the TFSA is the right answer if you're wanting to get into real estate, where you start with a TFSA, put away a little bit of money every week or month, let that portfolio grow if it's well managed, and you can pull that money out. No tax on your earnings from those stocks going up in value, which is the importance of using a tax shelter when you are investing in stocks. So yeah, maybe they work hand in hand with real estate. That could be a really nice way to do it. But of course, there's retirement investing too. So TFSA is more the short-term goal. I have something in mind that I'm saving up for, would make a lot of sense. Real estate is usually a very long-term play, again, because liquidity is low and the barrier to entry is high, with usually a larger upfront cost to get started in it. And RSP is probably the most common investing tool for anybody in Canada.
And a great way to think of it is kind of the bucket strategy. It's not one solution fits everything, but if you're saving for retirement, that's one bucket. That's likely a long-term bucket. That an RSP would be best for that bucket. If you're saving for your first rental house, your first home, or a car, TFSA would be a bucket for that. Or if you're saving for a college fund for kids that are maybe 10 to 15 years away, our ESP would be the bucket for that. And you can have different investments in each bucket. So RSPs may be the most growth oriented because of the time horizon. TFSA would be the most conservative because of the lower time horizon, and the RESP may be somewhere in the middle.
Yeah. Okay. Well, anyways, thank you for all that information. We hope that you guys find it helpful too. Important thing here is there's no get-rich-quick schemes that we've seen work for us, but I really do like the idea of real estate and the long-term benefits that it has, and we've learned a lot about those short and long-term in the stock market today too. So thank you for watching, and we hope that this information has been valuable.